Welcome to our deep dive today. We're going to be taking a look at Warren Buffett's 1981 letter to Berkshire Hathaway shareholders.
Mhm.
What makes this letter particularly fascinating is that it was written during a very, very tumultuous time for the U.S. economy.
Oh, absolutely. 1982, when this letter was released, the U.S. was grappling with some pretty serious economic headwinds. You had high inflation, a stagnant economy.
It was a tough time for everyone, really, but especially for businesses trying to grow and thrive in that environment.
For sure.
But you know what I find really interesting is that Buffett, he doesn't shy away from these challenges at all.
No?
In fact, he kind of tackles them head on, offering all this incredible insight into how to navigate these stormy economic seas, right?
Yeah.
And one of the most striking things that stood out to me was this vivid analogy he uses. He compares inflation to a gigantic corporate tapeworm.
Oh, it is a brilliant analogy, isn't it? Because it really captures this insidious nature of inflation. It's not just about prices going up. It's about how it eats away at a company's earnings potential, kind of like a tapeworm consuming its host's nutrients. It's silently devouring purchasing power. And this affects everything. Think about it. The cost of inventory, the money that's owed to the business, even the value of fixed assets, they all get impacted.
So essentially, it leaves businesses with a much smaller piece of the pie to reinvest for growth.
Yeah.
Or to even distribute to shareholders.
Yeah,
Yeah.
exactly. It's like you said, it's a smaller piece of the pie, and it's a particularly concerning problem for businesses that require a lot of capital, like manufacturing, for example.
Right.
Their costs are going through the roof, and if their returns aren't keeping up, it's almost as if this inflationary tapeworm is just feasting on their profits.
Yeah, so in essence, it's not just about prices going up. It's about the erosion of that purchasing power, which is a really, really important distinction to make.
Absolutely. And that's why it's crucial for investors to be vigilant and look for businesses with pricing power. The companies that can pass on these increasing costs to their customers without losing business in the process.
Makes sense. Buffett also goes on to caution his shareholders that even seemingly good corporate performance can be really deceptive, kind of illusory during periods of high inflation.
Yeah, he makes a really key point there. He emphasizes that even Berkshire's own impressive 21% return on equity in 81, it might not actually translate into actual gains after you account for inflation and taxes.
Right, which is a really, really important point for investors to kind of internalize.
For sure, yeah. It's almost like you're running on a treadmill, you're putting in all this effort, but you're not really making any forward progress.
Yeah, you're staying in place.
Yeah.
I also found his concept of the crossbar of passive returns quite intriguing, but to be honest, a bit complicated at first.
It is a new term, but it's actually pretty straightforward once you break it down. Think of this crossbar as the return that you, as an investor, could get practically risk-free from something like, let's say, government bonds.
Okay.
So if those bonds are offering, say, 8%, just as an example, any business that you're considering investing in, it has to earn more than that 8% to justify the additional risk that you're taking by investing in the stock market.
Well, that's a really clear way to put it. So companies can't just kind of coast along with mediocre returns anymore.
Exactly. In order to be attractive to investors, they really have to demonstrate that they can generate a return on equity that clears that hurdle, that exceeds those passive returns that are readily available elsewhere. And it's interesting because Buffett actually suggests that in some cases, companies with lower returns might even be better off just paying out most of their earnings as dividends.
Which seems a little counterintuitive at first, doesn't it?
It does, but Buffett's logic was that if those companies aren't using that money effectively to generate those higher returns, they should give it back to their shareholders, so those shareholders can then take that money and reinvest it somewhere else, somewhere that does offer the potential for higher returns, that can clear that crossbar.
Yeah, so it's like saying, okay, we're not clinging on to these low return businesses. Sometimes the smarter move is to actually return that money to shareholders
Yeah.
and let them decide where it's going to be put to work.
Absolutely. And that's very typical of Buffett's approach, very much focused on value creation, even if it means challenging the conventional wisdom of the time. And this focus on value creation, it directly ties into how he categorizes businesses as either good or bad based on their returns.
Right. And this idea is so central to his investment philosophy. Good businesses are those that can consistently beat that passive return crossbar, creating real value for shareholders.
Precisely. They're the ones that can kind of outrun that inflationary tapeworm that we were talking about earlier.
Right, right.
On the other hand, bad businesses, they struggle to keep up. You know their returns. They end up getting gobbled up by inflation, leaving very little left for the investors. And in the context of 1981, with that high inflation environment, Buffett was already acknowledging how difficult it was becoming to find those truly good businesses.
He was really sounding the alarm early on. And it
Yeah.
makes you wonder, doesn't it,
Yeah.
if a similar dynamic might be playing out in the market today.
Yeah. It's a question worth considering.
Now, speaking of finding those good businesses,
Hmm.
I'm curious about Berkshire's acquisition strategy back then in
Yeah.
81. Were they on a buying spree?
Well, I wouldn't say it was a buying spree, but they were definitely on the lookout for promising opportunities.
Okay.
Buffett clearly states in the letter that their preference is to buy high-quality businesses at reasonable prices, and this is important, even if those businesses happen to be operating in industries that are facing headwinds.
It's that classic value investing approach, isn't it? Looking for those kind of like hidden gems.
Yeah, you could say that. But there's more to it than just hunting for bargains. He also uses this really amusing analogy to highlight the risks of overpaying for acquisitions. He compares it to the fairy tale of the princess kissing a toad, hoping it'll magically transform into a prince.
Oh, yeah. This is where Buffett's humor really shines through, right?
It does, and he's actually making a really important point. He's saying that a lot of CEOs, they get caught up in this idea that they can magically improve a company's performance simply by acquiring it.
Wait.
So they end up paying these exorbitant premiums only to find out later that their managerial kiss, so to speak, it doesn't quite have the transformative power that they were hoping for.
Yeah, it's like no fairy tale ending there. So how did Berkshire manage to avoid falling into that trap?
Well, instead of trying to find toads to magically transform Buffett, he focuses on the underlying economics of the business. He looks for businesses with strong fundamentals, businesses that have the potential to generate real economic benefits regardless of their current market valuation. And if the price isn't right, they simply walk away.
They have the discipline to do that, which is impressive.
Absolutely. And he even mentions this major purchase that Berkshire almost made in 81. He said they loved the business, they loved the management team, but ultimately the asking price just didn't align with their valuation.
Interesting.
So they walked away. And this really highlights their commitment to creating value for shareholders, even if it means passing up on a seemingly attractive deal in the short term. But there's actually another really fascinating aspect of their strategy that we haven't touched on yet, and that's Buffett's concept of non-controlled ownership earnings.
That sounds very interesting.
Yeah.
Before we dive into that, perhaps we should take a short pause and come back to explore it further in the next part of our deep dive. Okay, so let's unpack this idea of non-controlled ownership earnings. It sounds a little bit complicated, but I'm really curious to hear how Buffett was thinking about this back in 81.
Yeah, this is one of those areas where Buffett's long-term thinking really shines through. Essentially, we're talking about companies where Berkshire held a significant stake, a big chunk of the shares, but they didn't have outright control. They weren't the majority shareholder. But Buffett believed that even though they weren't in the driver's seat, so to speak, they were still entitled to their fair share of the profits those companies generated.
So even though those earnings, they weren't immediately reflected in Berkshire's own financial reports, Buffett saw them as kind of like this hidden potential, this future value for Berkshire shareholders.
Exactly. He saw those undistributed earnings as almost like a silent partner, quietly working in the background to increase the value of Berkshire's investment. It's kind of like owning a rental property. Let's say you buy a rental property, but you don't live there yourself.
Right.
You're still entitled to a share of the rent, right?
Of course.
Similarly, with these companies, Berkshire gets a cut of the profits, even without actively managing those companies on a day-to-day basis.
Well, that's a really good analogy. So
Yeah.
those non-controlled ownership earnings, they kind of accumulate over time, even if they don't immediately show up on Berkshire's balance sheet.
Precisely. And Buffett acknowledged that, this value wouldn't necessarily materialize overnight. It's a long-term game. But he firmly believed that in the long run, the market values of those companies would eventually catch up to the intrinsic value of those businesses.
Right.
And those unreported earnings would ultimately turn into real tangible gains for Berkshire shareholders. And he actually gives some specific examples in the letter, doesn't he?
He does, yeah. He points to companies like Geico, General Foods, the Washington Post Company, where Berkshire's share of those undistributed earnings was really substantial. It kind of highlights how a company's true worth can go beyond what's immediately visible in their financial statements.
For sure. And that's a lesson that's just as relevant today as it was back then.
Yeah.
As investors, we need to look beyond just those reported earnings and really try to assess the long-term potential of the businesses that we're considering investing in. And speaking of looking beyond the standard metrics, there's another really interesting aspect of Buffett's approach that I thought was worth highlighting, and that's his shareholder designated contributions program.
Yes. This is where he basically allowed shareholders to direct a portion of Berkshire's charitable giving, right?
Exactly.
I found this to be such a remarkable idea when I first read about it. It's not something you see very often. It's a
Yeah.
company basically saying, we trust our shareholders to make these decisions.
It was a very, very innovative idea at the time. And the way it worked was that shareholders could actually choose which charities would receive their pro rata share of Berkshire's charitable contributions. And the response was incredible. Over 95% of eligible shareholders actually participated in this program.
Wow, that's a staggering number. It seems that people really do appreciate being given a voice, and the ability to align their investments with their values.
For sure. And it also speaks to this strong sense of community that Buffett had built among Berkshire shareholders. He treated them like partners, not just passive investors. He really valued their input.
Absolutely. This program, though, it seems like it would be quite complex from a logistical standpoint. Did he address how they were actually handling all these individual requests from shareholders?
Yeah.
He did. He did acknowledge that there were logistical challenges, especially for shareholders who held their shares through nominees like, brokerage firms. And he actually injects a little bit of humor here. He kind of pokes fun at the inefficiencies of some of these firms and how they were handling this process.
Oh, that sounds like classic Buffett.
Yeah.
Even when he's discussing these complex issues, he always manages to add a touch of humor to keep things light. But beyond the logistics of it all, it's just such a powerful example of his commitment to empowering shareholders, giving them a say. Before we move on, though, I wanted to touch on something that seems to be a recurring theme throughout this letter, and that's this idea of the importance of thinking long-term, especially during times of economic uncertainty. How did Buffett specifically address this concept back in '81?
Well, one way he highlights this long-term perspective is by emphasizing the importance of focusing on a company's intrinsic value rather than getting swept up in those daily or even hourly fluctuations of the stock market, the noise of the market.
Right. Can you remind us what he means by intrinsic value?
Sure. Think of intrinsic value as the true worth of a business based on its earning power and its assets.
Okay.
It's not about the day-to-day stock price. It's about the long-term potential of that company.
Mhm.
And Buffett really drives home the point that this long-term perspective, it becomes even more critical during times of uncertainty when the markets are volatile.
So it's like saying investors shouldn't panic when the market inevitably takes a dip.
Exactly. He believed that true investors, they should see market downturns as opportunities, as a chance to buy great businesses at bargain prices. Of course, this requires a lot of patience and discipline, which he clearly possessed. But he saw those market fluctuations as just noise, not a true reflection of a company's underlying worth.
It's easier said than done, though, right? I mean, that level of patience and discipline, it's something that a lot of investors, myself included, we struggle with, especially in today's fast-paced world where everything seems to move at warp speed.
Oh, you're absolutely right. It's very easy to get caught up in the short-term hype and lose sight of the bigger picture. But, Buffett's 1981 letter, it serves as this powerful reminder that the best investments, they're often the ones that are held for years, if not decades. Time is your friend in investing.
This has been a really fascinating exploration of Buffett's thinking during a very tumultuous time. But there's still so much more to uncover in this letter. Should we take another short pause and come back for the final part of our deep dive? All right, welcome back to our deep dive into Warren Buffett's 1981 letter to Berkshire Hathaway shareholders. We've been really exploring his insights on navigating a very challenging economic climate.
Yeah, we've covered a lot of ground, haven't we? From the insidious effects of inflation to the power of thinking long term. And of course, who could forget that really innovative shareholder designated contributions program?
Yeah, a really remarkable program. It really showcases his very unconventional thinking and how much he valued his shareholders as true partners. But as we wrap up this deep dive, I'm wondering if we can maybe distill some of the key takeaways for our listeners,
Yeah.
what are the big lessons that still resonate today, decades later?
Well, I think there are several crucial points that Buffett really hammers home in this letter that hold true even today, all these years later. First, I think we really can't underestimate the impact of inflation. It's not just about prices going up; it's about that erosion of your purchasing power, like we talked about earlier. That tapeworm analogy really is so apt because it captures that insidious nature of inflation.
So even if the market, looks good on paper,
Yeah.
you can still be losing ground if inflation is running rampant.
Exactly. And this leads us to the second key takeaway, which is that businesses, they really need to generate returns that surpass those readily available passive returns. They have to clear that crossbar that we were talking about earlier to truly create value for their shareholders.
Otherwise, you're just treading water, or worse, losing ground.
Precisely. And this brings us to, I guess, the third key lesson, which is the importance of disciplined capital allocation. Buffett's story about that almost acquisition in 1981, it really demonstrates that bigger isn't always better. It's about making smart investments that generate real economic value, even if it means walking away from a tempting but overpriced deal.
It's about resisting those toad-kissing impulses and really
Yeah.
focusing on finding those princes, those companies with solid fundamentals and real long-term potential.
Exactly. And finally, I think Buffett really emphasizes the power of thinking long term. Don't get caught up in the daily or even hourly ups and downs of the market. Focus on a company's intrinsic value. Let those non-controlled ownership earnings compound over time, and be patient.
So patience, discipline, a keen eye for value. Those seem to be the hallmarks of Buffett's approach, wouldn't you say?
Absolutely, and those are principles that have really stood the test of time. But here's a final thought I'll leave you with to kind of ponder as you navigate your own investment journey. In a world where passive returns are so readily available through index funds and ETFs and things like that, how can you, as an investor, how can you identify those truly exceptional businesses, those good businesses? How do you separate the princes from the toads, so to speak, in a market that's often driven by speculation and hype?
That's a great question to leave our listeners with. It really reminds us that even though Buffett's 1981 letter was written, decades ago, the insights that he shared are still so incredibly relevant today.
They are. And if this deep dive has piqued your interest, I highly recommend checking out the full letter yourself. It's really packed with insightful nuggets, and of course it's full of Buffett's trademark wit and wisdom.
Thanks for joining us on this journey through one of the most insightful documents in investing history. Until next time, keep learning, keep exploring, and keep diving deep.